And for best experience, go on mute and put your phone on airplane mode, because we want to use the next 30-35 minutes to really understand the information. Uh, just some callouts before we begin the session. I'm not a financial advisor. The intention of this session is not to give you any financial advice. You should consider seeking independent legal, any financial taxation advice, and should not probably be using this session to take this as your financial advice. The intention of this session is to take you through and give you a little bit of understanding how can you build a sustainable portfolio using ETFs, but don't treat this as a financial advice. And just ensuring that do not take decisions based on this. Use this as your starting point to build your knowledge in this space. Most of you know me, so I'm not going to harp too much on this one. But yeah, teaching is a passion for me. I've been doing it for a very long time. I think about more than a decade now. These are some of the social handles where you can see where I share stuff. Also, recently I've started a Telegram community. Most of the new events and any education series that we are going to run, I'm going to publish that information on Telegram. So make sure that you're joined on that one. What I will also do is I'll send off every link that we have talked about today in an email after the session. Cool. So before we talk about ETFs, right, let's really understand what are the different types of investments which are available to any individual investors. So we're not talking about any corporate or and other types of investor, but to an individual investors, what are the different types of investment options that are available? One of the scales which I use to determine the investments and actually evaluate them. A lot of people look at risk and reward, but in today's day and age, we should also look at how much time you have to spend to understand and get the most out of investment. And on the other scale, what sort of returns can you expect? So what you're going to see next is based on my personal experience, also experience that I have seen some of the other advanced and experienced investors to go through. So some of it you may not agree personally in your personal philosophy, but this is based on my experience and speaking to a lot of experienced investors in my space. So let's kick off. On this scale of so if you are to the right hand side of the time, then that means that's the time that you have to spend to make any legible returns in that space. And on the return scale, the higher you are, the more return that you make. So I hope that this graph is clear. Now, I'm just going to check if there are more people who are, yeah, I think there are more people who are waiting. So let me just quickly add them to this meeting. Cool. So I've added a few more. Now, in terms of, in my experience, the worst thing that you can do for your investing is dealing in future on options. They don't give you much returns, and they suck up all of your time while trying to find a profitable strategy in that space. I think in that category, I will also probably add a new age asset, which is crypto. Generally, I've seen people spending a lot of time, but you don't get any desirable or meaningful returns out of that asset class. A steady sort of an investment asset is bonds. You spend less time in evaluating them, but you also make cash sort of returns, the amount that you would probably keep in your saving accounts, that sort of returns that you would make. In my personal opinion, the best bang for buck, the money asset that you can buy is real estate. But again, if you look at in the time horizon for real estate, you have to spend significant amount of time to get those sort of returns. So when I speak of time, what I mean is the time that you personally have to invest to understand that asset class and make any meaningful returns, not the duration of time that you're invested in that asset. So hopefully that distinction is clear. Uh, Again, similar, you can make fabulous returns in stock, but again, you need to do a lot of research, active investment of your time to make any meaningful returns in the stock. Then there is an asset class. Again, it's called active funds or mutual funds in some countries. Here, you have to carefully go and see which managers have done well, give your money to those managers, and then they invest on their behalf. It's again a very good asset class. As you can see, in they do give decent returns, and you only have to spend half as a time as typically what you would spend researching crypto projects. Then a lot of people like investing in gold, silver, other bullion assets. So just give me a second. I'm just adding a few more people who have recently joined. So in this case, again, people like investing in bonds, people like investing in gold, people like investing in silver. So bullion assets are your basically commodity assets. Uh, you don't have to spend too much time thinking about them. You can just go and buy physical gold, physical silver, or digital gold and digital silver. But in my experience, the return are usually below the mutual funds and below the stocks and the real estate. And finally, you have got ETFs. So the ETFs, what they give you is you don't spend practically too much time trying to choose them, but they give you a very decent return. Uh, I think they will be as good as mutual funds or somewhere below the mutual funds in terms of the return scale. So if you are a busy professional, right, the intention that you have is you want to be on the left hand side of, you want to be here, somewhere here, and you don't want to be here. Because if you are on the right bottom side, right, you're investing so much time but you're not getting any returns. If you're on the left top bottom uh, on the side, then you are really good because you're investing less time, and you've gotten a lot of good returns. And then again, if you're somewhere here, which is the real estate and the stocks, you're investing a lot of time, and that's why you're making returns. So I hope that gives you a bit of perspective how these asset classes stand with respect to the time that you typically would spend in generating decent returns from this asset class. Now, before I proceed, for the folks who joined slightly late, I did put up a form where you can put in your questions. And what we will do is at about halfway mark, when we are done with the information pack, we'll probably try and look at those questions and see if we can get them through in the 1 hour. Cool. So we will now go to the next set, which is the focus for today's session. We'll talk about the exchange traded funds. And if you're not speaking, if you can, I can getting some feedback. So if you're not speaking, if you can go on mute, that will be really great. Thank you. So exchange traded funds, very simplistically, what they are is uh, there will be an index, or there will be a bond, or there will be Bitcoin or gold. A company, what they will do is they will take your money, pool that money, and invest in that particular asset. Is a very simplified definition of exchange traded funds. Again, I'm getting some feedback, so if you're not speaking, if you go on mute, that'll be great. Now, why exchange trade funds have become really popular? I think there are really key four reasons why the exchange traded funds are really popular with busy investors. Uh, Low cost. The exchange traded funds typically don't charge a lot like active funds or some of the other instruments that we talked about in the last slide. They're easy to start. Sometimes you can start even as low as $500 to do the investments. I've seen some brokers now offering you even $50 or $100 starts. Most exchange traded funds would not require any active involvement from you. So they are really like a set and forget sort of a investment vehicle. You identify, you review, you put up an allocation, and then you typically go on and just continue to invest in them. So they're very passive in nature. And what in my studies, what I found is that you make typically an average market returns. So because you're betting on the human progress, you would see that generally all good exchange traded funds, and we'll talk about some examples later in the information pack, typically will make you market returns. So you can be totally inactive and passive and still make average market returns. So if you remember the previous slide, right? If you want to make higher returns, if you want to get on to the right hand side of the return graph in that we discussed in the previous slide, you have to invest more time, and definitely if that is something that you're looking to do, then you should look at those asset classes. But if you're looking to make average market returns in reasonable amount of time, then you should be looking at exchange traded funds as an option for investments. So now let's look at what have we got in terms of the exchange traded funds. Now, one thing that you will find in Australia is that there is an ETF for everything in Australia. In fact, you will find hundreds of country specific funds, funds that are investing in Japan, funds that are investing in US, funds that are specifically investing in India. So that's one type of broad based of ETFs. What you will also find is you will find a lot of sector specific ETFs. You'll find one ETF which is dedicated to healthcare, another ETF which is dedicated to technology. Then you might have another ETF which is totally focused on cybersecurity. So you'll find a lot of variety in terms of sector specific ETFs. And then finally, what we have started seeing, especially after the COVID 19 2020, you also find a lot of asset specific ETFs. There'll be one ETF which will just track the price of the gold and you can invest in that, or a price of Bitcoin and you can invest in that, price of US bonds and then you can invest in that. So for an average investor, right, I think on Australian markets, if you can go to this link, you will find that as of I think I checked 15 days back, there are 400 plus ETFs that are available to anyone who wants to invest in, who wants to use ETFs as an investment vehicle in Australia. That makes tasks for an individual investor very difficult, right? Should I invest in one or should I invest in number 400? Because it makes life really difficult. So I hope in this session, what I will try to give you is one strategy that you can use to really boil down to what sort of ETFs that you can invest in. So let's look at what we can do, because definitely nobody will have bandwidth to really understand 400 different types of ETFs and then pick few that they would like to invest. So I keep talking about this $1 million Aussie portfolio. Uh, the reason for this $1 million Aussie portfolio is uh, there is a rule of 4%, which is very famous in investment world. Now, what I would want you guys to do is do a quick maths either on your phone, or you can do that on your computer. Typically, the minimum wage that you can make in Australia is about, I think, $20 an hour, and if you work $20 for a full week, you're making about $800, 40 into 20, and then if you work for 50 weeks, you're making a 40 grand uh, as a minimum wage worker in Australia. So about $40,000. Now, $40,000 for $1 million is about 4%. And I talked about previously about the 4% rule. The 4% rule is that once your portfolio reaches a certain size, if you spend 4% of that portfolio every year, the portfolio remains through your life without really finishing off. So let me give you an example. Say, for example, you build $1 million portfolio, and after you build the $1 million portfolio, every year, if you sell 40,000 worth of ETFs from that portfolio, you can continue to have that $1 million portfolio serving you for rest of your life. So that's the 4% rule. So I imagine if you have a $1 million portfolio, you will have probably one earning member who is contributing every year $40,000 to your household, and that 40,000 can be used for a lot of things. Some people can choose to work part time. Some people can use it for educating their kids. Some people can use it for retirement. So there are many uses that people can do. So that's why I give this simplistic goal to people to try and target to get to a passive $1 million AUD portfolio, because that brings a lot of options in your life, and you can do a variety of things once you get to that portfolio. Now, it's not easy. A lot of people won't be able to get to the $1 million portfolio straight away in 1 month. However, there are a lot of paths. Now, I'll give you some examples, right? With a lot of people, they're able to save $5,000 deposit a month. If you do that every month for 11 years, then with an 8% return assumption, you will get to $1 million portfolio. So I'm getting still feedback on this line. If you're not speaking, if you go on mute, that'll be great, so that we can just continue on this session. Thank you. Now, a lot of people say me 5,000 deposit every month is a really big amount, especially if you're a student, you're a teenager, you're starting now. Contribute just $2,000 every month, and then in 20 years with 8% return assumptions, you can get there. 20 years might sound a lot for someone who is 45, but someone who is 18, 20 years will only take them to 38 if they consistently do this thing. And someone who is a very high earner, who's got high rates of saving, they can do it even in 6 or 7 years. I've got the third example where you deposit $10,000 every month for 7 years, and with an 8% return assumption, you can do that. Now, I've just listed out some scenarios that you can use, but what I would do is ask you to do some practice, trial and error. There is a MoneySpot compound interest calculator. Use that to come up with an amount which you think can get you to the $1 million portfolio. I've just listed out some examples. Deepak, I'm hearing a lot of feedback from your line. If you can go on mute, that'll be great. So now what the intention today that we have is, once you have understood that this is possible, and obviously we need to work towards this goal, then after your trial and error, the next question that you will have is, how do I select out of these 400 different ETF options that we have in Australia? So I'll give you one strategy that has worked for me. Again, not a financial advice, not sure if that will be suitable to you, but let's discuss that. So what I use in my own personal strategy is, it's called as ETF rejection framework. Now give me a minute. I'll try and see if I can mute a couple of guys, because I'm getting a bit of feedback on Deepak's line. So I'm going to see if I can mute him. Yeah, I think the platform doesn't give me an option to mute him. So I'll continue. So in the ETF rejection framework, what the idea for me is that you have got this 400 different ETFs in Australia. I will only have bandwidths to really understand four or five ETFs or maximum seven ETFs that I can fully understand, and then I can keep build that goal of building $1 million ETF portfolio. So I use this ETF rejection framework to get from 400 to about 5 or 10. Now, the way I go about is, unless I have a very strong knowledge in a specific area, I would try and avoid asset specific ETFs. Like, if I know a lot about gold, if I know a lot about Bitcoin, if I know a lot about bonds, I will deal in the asset specific ETFs. But because I don't have much knowledge in that, typically that's a cross for me. If there is an asset specific ETF, I generally don't pay any attention to it. Then I talked about sector specific ETFs. Say, for example, you are a healthcare professional, or you are an IT professional, or you are a cyber professional, or you work in transport or urban infrastructure. Then you will know a little bit more about that sector than anyone else. Then, in that case, you can actually think about investing in that sector or that theme. But typically, as I was saying, right, if you have very deep specific knowledge in that sector, typically I would avoid, like, if you work in healthcare or if you work in cybersecurity, you work in urban infrastructure, in some of those themes you will know whether that industry or that sector will do well. Then you can pick up that sector specific ETFs. But generally that's a no for me. So that leaves us with country specific ETFs. Now, I'll give you a method which you can use to choose country specific ETFs. What we will look at is look at the history of how different countries have done, and then go about selecting the ETFs based on that data. So you can go to this link in Vanguard, and it will give you the investment return data, I think right from 1970s up until 2023. So what I have done is I've taken three different data points. Now the first data point is around the dot-com era, like how have equity markets of different countries or different asset classes have done after the dot-com era. So if you look at the post-dot-com era returns, Australian markets have done really well. They've done an average of 8.2, just a tick over the international property, uh, handsomely beating the US share markets at 6.8% average return over that period of 23 years. This table also will give you like what is the maximum in a year that asset class has done, and what is the minimum that asset class has done in that particular year. Now, in terms of really understanding the data, is that what has worked over long duration of time. So, if you look at this data, it will tell you that clearly the Australian shares have done really well over that time frame. If I look at another data point, which is how have equity markets of different countries or different portfolios have done post the global financial crisis that happened in 2008. If you look at that data point, you would see that the US shares have really, so they caught up. They didn't do much in the last decade between 2000 and 2008, but they really caught up after the 2008, and right until 2022 2023 they have done an 11.5 or 11.6 percentage average every year. But if you look at Australian shares, they've done half of that, so really underperformed the US share market. In if you look at the data point from a post GFC perspective, and if you look at cash, that has done terribly, just to 2.8%. So actually leaving any money in your saving accounts has not been a great decision. Now, if I look at another very key uh, event that happened in the last decade, which is the COVID 19, spreading of the COVID 19 disease in 2019, end of 2019. If you look at data after that in last 4 years, again you would see that the US share markets have done really well, and the Australian markets or even the international markets have been no match to the US share markets. And if you really look at bonds, they have gone into negative in that territory. So people have lost money by investing in international property or Australian bonds or international bonds, because the rates have gone down almost to zero, and now they've started picking up in last 1.5 years. So we've looked at three data points. We have understood that what has really worked in short term, medium term, and long term. Now we can use these data points to put up a thought or a strategy towards how will we build our country specific ETFs. Now, another thing that I wanted to show you was how today the market is split. So if you try and put all of the world's equity market on a page, this is how it will look like, right? The biggest pie is the US share markets, followed by China, and then Japan, India, and then others. And then you can also see Australia somewhere at the bottom with that 1.6 trillion market cap. Now, in if you look at this specific data, right, you would know how generally a stock market of a country is usually driven by how the country's economy is doing. So, over long term, there is a great correlation between the growth of GDP of a country versus the growth of the stock market of that country. So, if you just for an example, if you look at the Indian economy, went has gone from $1 trillion to a $4 trillion economy in space of 7 or 8 years, and similarly their stock market has also quadrupled over those 7 or 8. It used to be $1 trillion market cap country 8 or 9 years back, and now it's about $4 trillion market cap. So generally, if you can be very optimistic or about how the country is doing, you probably know that how their markets are doing. Obviously, the valuations and a lot of other things come into picture, but barely if you look at if the GDP is doing well, then typically the stock markets would do well, and that is why we opt for something like very country specific, broad based ETFs. And if you look at the US dominance, it's been largely fueled by this seven companies, which itself have $13 trillion of market cap. Obviously, they have been the innovators. They have global presence. They not only dominate US but also dominate worldwide. This seven companies, the US companies. So, what could be an ETF rejection framework that you can build using this knowledge? So, we said we're going to focus on the country specific ETFs. One option could be that I can actually just choose three buckets. Bucket one could be Australia, because I know that long term record of Australia building wealth is good, about 8.5%. I can put one bucket of money in Australia. I know that US is the global leader today, is the global powerhouse of innovation today. It's very likely to remain in my investing time frames a global leader. I can choose to put one bucket of money targeting US, and then the third bucket of money could just go to the leaders of tomorrow. So if I think China is going to be dominant in 20 years, or if I think India is going to be dominant in 20 years, then I know that betting on some of those economies, look at the difference which we had in the previous chart, right? Like India was $4 trillion and US was $52 billion. If India were to become like US in 30, 40, 50 years, then that economy can grow, or that stock market can go from $4 trillion to $50 trillion. So that's almost a 12x or a 13x of the overall market that can go. So that's one strategy, right? I can put one bucket of money in Australia, another bucket of money in US, and the third bucket of money in leaders of tomorrow. And that is how I filter down from 400 or ETFs that we have got to the four or five different ETFs. In the next information slide, what I will show you is how a hypothetical portfolio can be constructed using this framework. So as I said, like our first bucket is US. So you can choose to put broad based in US. You want to use a broad based index, their top 500 companies. You can go with IVV, or you want to do 100 top 100 technology companies, you can do NASDAQ, which is NDQ. Or if you are very sure that you want to do You know that the magnificent seven or the top technologies companies are really going to dominate next 20, 30, 40 years as well, then you can actually get exposure to them as well using the FANG ETF. In Australia, there are two good options. Like you've got a broad-based exposure to the top 200 companies or the top 300 companies. You can use A200 or VAS. A very simple options that they are there. And then if you look at the emerging markets, you have got options like VGE, which goes and invest in all the emerging markets outside the US and Australia, all the emerging markets that are there. They go and put money there. Or you can choose Asia, which has got a very strong dominance of investing in technology companies in China and some in India. Or the other option is uh, you can go and invest in the top 50 companies of India using the India ETF. So that's one way of thinking. How can you hypothetically create a shortlist for the ETFs that you're going to go and invest in? Remember, the goal is not to copy this shortlist. This is how I have arrived at, but use this thought process, spend some time to come up with your own approach of identifying and getting to the shortlist that you would want to invest in. Now, before I leave, I would like you to keep these two things in mind. On any ETF, look for the tracking error. You want to ensure that the tracking error is as low as possible. If it is zero, that's really good. But I have not found much ETFs will have the tracking error of zero. Tracking error is essentially, are they tracking the asset correctly or not? And you would want an ETF to track their assets correctly. The other thing that you should look at is you should not be paying much fees. If there is a similar index where five different providers are providing an ETF, choose the one which has got the lowest fees and a decent fund size. You don't want to invest in very small ETFs as well. Anything below 10 million AUD you should probably ignore, because unless it's coming from a very reputed fund house and it's a new offer and it's index which was not previously covered. But if you have any specific questions, ask me and I'm happy to help on that. So keep these things in mind before you actually start your journey. Now, final thoughts. The best overall resource or the website to educate yourself is the passiveinvestingaustralia.com. I have extensively used it. It's been an existing old website for many, many years now. Gives you typically answer to pretty much every frequently asked questions that you will have on the ETF investing journey. Today I use Parallel and Self Wealth for my investing. So the idea here is to ensure that you also do your research. But I found these to be cheaper options for investing in ETFs. I think the very recently Beta Shares have announced that they are going to charge zero on their platform for any ETFs in Australia. So also explore them if you have not started on your journey, because any fee that you save actually gets added to your investment portfolio. So it might be a very good idea just to ensure that you've got that option of investing in ETFs without paying any platform fee or brokerage. So use that as an option. With that, I'll keep it as an open session. I know we've had a mischap today, which we were not able to really complete the session with the first call that we've had. I will try and use a different platform next time so that we've got much granular control of if there is any disturbance so that we can mitigate it. However, what I will do is I will leave the link to the form if you have got any questions on these sessions. I will read up all those questions and send you a video response in our Telegram. Make sure that you join the Telegram group, and I will also post all the upcoming sessions in the Telegram group, and hopefully I'll see you then. I hope today's session was a bit of information and also a push to start on your ETF journey, and I hope you guys have a great weekend. Thank you.